Finance and TikTok aren't really two words that go well together. Some advice on there is outright insane.
If you saved $1 a day for a year, do you know how much money you'd have? Roughly $30,000.
So stay tuned, today we're going to be reacting to Finance TikTok. If you don't already know, this is episode 2 in the series. If you want to watch episode 1, click up there. Enough with the intro, let's get straight into it.
This is your lunch. Now, you should be able to do whatever you want to with this, right? If you want to eat all of it, great. If you want to throw it away in the garbage, that's your prerogative. But here I come, the government. And I get to take 40% of your lunch.
Not the juice.
And that, Lauren, is how taxes work.
He's right, that's pretty accurate. This clip is from Parks and Recreation. It's such a funny show. And he's right, that's what it feels like. The government does just come and take a chunk of my salary. Now this reminds me, I've got a question for you guys. Salaries are advertised as pre-tax salaries. A job will be advertised at, say, £45,000 a year. But that's pre-tax. After tax and national insurance, that's not what you'll be earning. In your account, you'll probably get £34,785. And that's a pretty big difference. That's a shade under 26% of what's advertised versus what you'll actually receive. So what do you guys think? Do you think salaries should be advertised as pre-tax or post-tax? Let me know down in the comments below. But if we get back to the video, he's right. That is what tax feels like to me. Next.
Where the pressure's so hard from workers saying, I don't want to drive into the city an hour and a half and drive home an hour and a half every day. But I also think a nice little recession will clear this.
That's Barry Sternlicht. He has a net worth of 4.6 billion, that's billion with a capital B, dollars. The repercussions of a recession affect lower income households disproportionately more than they'll affect him. He's worth $4.6 billion. He's got enough assets in different industries that he can liquidate at any time, and he'll be fine. A recession won't affect him. A recession will affect people like you and I. We could lose our jobs. People who are struggling will fare even worse. During a recession, unemployment goes up. And if you haven't seen the clip from The Big Short, there you go.
You have any idea what you just did?
Come on, we just made the deal of our lifetimes. We should celebrate.
You just bet against the American economy, which means if we're right, people lose homes, people lose jobs, people lose retirement savings, people lose pensions. You know what I hate about banking? It reduces people to numbers. Here's a number. Every 1% unemployment goes up, 40,000 people die. Did you know that?
No.
Did you know that?
No, I didn't know that.
For him to say that with a straight face is absurd. Next.
Stop buying coffee for $5.50. You know, you go to work, you spend $15 on a sandwich. What are you, an idiot? It costs you 99 cents to make a sandwich at home and bring it with you. You start to add that up every day, it's a ton of money. Most people, particularly working in metropolitan cities that are just starting out on their job, making their first $60,000, it's away about $15,000 a year on stupid stuff.
I mean, okay, he's not wrong, but I think if I can't afford to buy a coffee from outside once a week, the problem really lies within the economy if I'm having to scrounge for every last pound or dollar. But then again, on the flip side, he is right. Buying food from outside every day or coffee from outside every day does add up. Those expenses do add up fairly quickly. If you're starting from zero or it's your first job, then you kind of do have to scrounge for every last pound or dollar and really do your best to live below your means. Lifestyle inflation is one of the largest obstacles to becoming financially free. If you like eating outside and spending money on food and coffee outside, like I do, here's a little exercise I did. If you go into your banking app and add up all the money you spent in the last calendar month on food or coffee from outside, it'll help you get a clearer idea of how much you're spending. And in my case, it was definitely an expenditure I didn't want to continue having over the long term. Next.
Bitcoin just surpassed the Russian ruble to become the 14th largest currency in the entire world. BlackRock holds over 150,000 Bitcoin in their ETF, which represents just under $10 billion. Wells Fargo and Merrill Lynch are both offering Bitcoin spot ETFs to their clients now, and the CEO of Vanguard just stepped down. Last month, he claimed that he would never allow Bitcoin ETFs on the platform. Although Bitcoin ETFs only launched last month, they're already nearly half the size as all gold ETFs. At this point, it seems like Bitcoin's rise is inevitable.
It's a pretty dangerous exit statement. It's true, you might have seen in the news, there are now Bitcoin ETFs, exchange-traded funds, now being offered to retail consumers. Are they on offer to retail consumers? If they're not already available to retail consumers, they will be quite soon. Now, you might think that large and reputable firms like BlackRock and other banks holding Bitcoin and buying Bitcoin and offering Bitcoin ETFs means they're a safe investment, right? Well, I would hold your horses on that thought, because big institutions are notorious at wriggling their way out of any economy if something should go wrong. It's usually consumers and retail investors who have to bear the brunt of any outfall. Exhibit A, the 2008 financial crisis. Now, Bitcoin is due to undergo a halving process this April, I think, and that's where the number of Bitcoins actively being mined and sold into the market will half. Now the theory is, since there are less Bitcoins being admitted into the market, people are banking on the fact that demand will remain the same, and theoretically that should drive the price up. But in all honesty, we don't know how the market's going to react, not only because we don't have enough historical data on the crypto market to be able to make informed extrapolations about how it's going to perform in the future, like we do with the stock market, but also because us analysts, we still get predictions wrong. You can conduct a lot of analysis and make an educated guess. I would argue it's still a guess. It's impossible to predict the market. Next.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Yeah, so stocks are very volatile over daily intervals. Their prices fluctuate a lot over the short term. But if you were to extrapolate those fluctuations out over months and months and years, then you should see that they'll steadily go up. I think the important thing to note here is that he says you're buying a business, you're not buying a stock. A business is always going to want to do well, increase its market cap and profits. No one starts a business with the intent of losing money. But over the short term, a change in regulation or a lack of funding can cause a dip. But ultimately, if you're invested in the right thing, the price, like I said, should steadily go up. Simply because a business's main aim is to make more money. That's good advice. Next.
You shouldn't pay any tax on the first sort of £100,000 you earn in your life. So instead of giving people a tax-free allowance every year, okay, it should be upfront weighted, because young people need money more than older people.
And that's cumulative, right?
Yeah, so you might be earning £20,000 a year. For 5 years, you'd earn £20,000 a year, just to give an example, and you wouldn't pay any tax on any of it until you hit that £100,000 threshold.
That's an interesting concept, because I do think that young people are unnecessarily handicapped by taxes. Now, if you don't know who that is, that's Rory Sutherland. He is let me read this, get this right. He's a behavioral science marketing executive. And that concept is really interesting because more money in the pockets of young people would allow them to innovate and be more creative. Young people, or those on a lower income, don't have the capability or knowledge to put money through a limited company or use other schemes that the super wealthy use to avoid paying exorbitant amounts of tax. I mean, you just don't have access to world-class accountants or teams and teams of tax advisors, and a £100,000 buffer would be an interesting implementation. Not that anyone's ever going to do it, because statistically, the poorest 10% of the UK population pay 43.5% of their income in taxes. Yeah, like I said, you just don't have access to the loopholes that very wealthy people do. Next.
Absolutely. And that's a very alluring, enthralling, riveting question you're asking there. You know, before we get deep down into the sort of bœuf bourguignon of the question, you know, we must first ask ourselves, you know, what is the chambre de séparé? You know, that's kind of the coquin vin that is intertwined.
I do feel like consultants in some cases, how do I say this nicely? I don't know if that's just McKinsey Consultants. We're not going to slander McKinsey and McKinsey alone. A lot of consultants in general are like that. Some big flowery words to confuse you and make you forget what their actual purpose is. That was a good one to end on. Well, that's all for this video. Thanks for watching. If you liked it, be sure to check out my Analyst Reacts playlist. Leave a like and subscribe down below, and I will see you guys in the next one.